Okay. So yeah, IAS 24 related party disclosure. Once again, this is a disclosure standard. And when it comes to disclosure, things that we need to disclose in our financial statement, either in the body of the financial statement or as way of what? Of note. So yeah, let's look at intro. IAS 24 related party disclosure requires what? The disclosures about transactions and what outstanding balances with an entity's related parties. So more or less, this is what the standard requires from us as accountant, that we should be disclosing information relating to transactions that transpired and any outstanding balances between the entity we are working for or we are working with Mamuko Wesley Gramano against the related parties or parties that are related to the entity. So the standard defines various classes of entities and people as what related parties and set out the disclosure required in respect of those parties, including the compensation of key management personnel. Related party relationship area is a normal feature of business. So, okay, this is not CIT. Let me say this. Sometimes, because of tax, the moment they hear related party, they start thinking otherwise. They make you feel as if it is an offense to have a related party. It is not an offense. Okay, it is normal to have a related party. So if you're an accountant of an organization and GRA comes to you, why your related parties bring this, it's not an offense to have related parties. Okay. The existence of related party relationship and transaction may, so this is why GRA is on you. They will be on your neck, may affect the profit or loss of an entity. And who do I have here? Doris and Grace. You both should forgive me. I always like to use mothers as an example here. So when you sell goods to your mom, when you give your mom your product, your mom is like, "Oh, Charlie, give me some of your product. I'll pay you." Okay. So this, like, we are looking at it from the family point of view. You give the goods to your mom, then when it's time for payment, your mom tells you, "Me na me, say me na make so I me yim for 9 months." She start giving you life story that would probably have an effect on your going concern. Okay, so the existence of related party may have effect on your profit or your loss. Sometimes she will pay, but she will not pay like the standard price. Obeka will say, "Nti me am here we busunya na me yo mama so o ton ama me te say abonten so ni." So it means you have to give some discount. Okay. And that is why, once again, that is why GRA will be on your neck. Because for them, they expect you to transact with your related parties at arm's length. So no favoritism. So if there is an existence of related party transaction, they will look at it, and if it is not at arm's length, they will reward, characterize the transaction, and they will do proper justice. That's what will affect your profit. It means you'll be making more profit. You have to pay more taxes and all those things. If you have made payment to your related party and there is any withholding and all those things needs to be computed, they will do that for you and they will slap you with some interest and penalty. I'm just saying this because probably some of us are working as accountants and these are practical or real life challenges that you guys will be facing. Okay. Objective of IAS 24. The objective of IAS 24 is to ensure that an entity's financial statement contains the disclosure necessary to draw attention to what the possibility that its financial position and profit or loss may have been affected. Once again, may. It is not always the case. Sometimes you will sell to a related party and it's going to be at arm's length. Okay, so may have been affected by the existence of what? Related party transactions. Then by related parties and by transactions and what? Outstanding balances with such parties. Related party. So a related party is a person or an entity that is related to the entity that is what? Preparing the financial statement. Mostly you get to see, they get to use this when you are looking at it from the group point of view, consolidation. Okay, so parent company, subsidiary, associates, that kind of thing. You get to see it at that level. A relationship typically exists if control, joint control, common control, or significant influence, and these are terminologies that you'll be coming across when you're doing consolidation, exist between the party and the reporting entity. This is the accounting definition. The taxman will tell you that when entities are in a controlled relationships, then that is a related party. Related party relationship and transactions are normal feature of business once again. However, there is a general presumption that transactions reflected in the financial statement have been carried out on an arm's length basis unless disclosed otherwise. Arm's length means on the same terms as could have been negotiated with an external party, in which each side bargain. Once again, it has to be with parties who have knowledge in that field and freely unaffected by what? Any relationship between them. So all your dealings, okay, when you are reporting or preparing a financial statement, the assumption is that the sales you have there is at arm's length, irrespective of who the person is, whether the president, your mother, your father, it is at arm's length. Unless you disclose that, oh, okay, I give discount. So we have discount of X amount, okay, or there was an arrangement between party A and my company, and during the arrangement, this is what we decided to do. So unless stated, unless there is a contrary arrangement, then you have to state that in your financial statement, or you have to disclose it. Even if a transaction with a related party is at market value, the shareholders needs to know if it is not at arm's length, because the relationship could influence future transactions. This is also important when you are even let me say selling your company to another person. Okay, because there are some benefits that your company or you are getting as a result of you having another person or another entity being a related party. If the company is being disposed of or sold to another person, that related party relationship might be neutralized or might go off. And that benefit that you were getting, that probably is making the organization make more money or is known globally, may be cast off, right? And if that is the case, when the person buys, if the person doesn't have any knowledge that this particular function, let's say the marketing function, is being managed or run by a related party, okay, and that is why the company is known globally, and the person buys the company, the person will expect to enjoy that benefit. So that is why you have to do what? Let any shareholder or stakeholder be aware that we have what? A related party. So a person or a close member of that person's family is related to a reporting entity if that person, one, has control or joint control over the reporting entity, two, has significant influence over the reporting entity, and three, is a member. In fact, I think when they want to examine you under the IAS 24 as a standalone standard, they mostly like to use this. When it comes to publication, no, they don't mostly examine you on IAS 24 when it comes to publication, but they can examine you on as a standalone standard, and that should be like 7/10. Yeah, 7/10. And evening. And even out of that, I think this portion should be like 8/10. Unless you are doing consolidation, okay, then that is where this two becomes like relevant. But as a standalone standard, mostly they like to use Shadrach is the head of finance of ABC Limited. His wife is the head of finance for another company. So they like to use that like family tree thing. Okay. So it's a member of a key management personnel of the reporting entity or a parent of the reporting entity. Please, are you guys following? This one we will not be doing any computation. So if you are waiting for computations, any be better.
Yeah, we
Yeah.
are here with you. Yes.
Okay. This is a disclosure standard. So it's about writing theory and all those things. Okay. B. An entity is related to a reporting entity if any of the following conditions apply. So the entity and the reporting entity are members of the same group. So despite group of companies, we have OKFM, we have UTV and all those things. So they are members of the same group. One entity is an associate or joint venture of another entity. So I think, yeah, it should be this class where I said family. And family, we have parents. Remember, siblings, and we have what? Relatives. I think it's this class, oh. So parent company, subsidiary, and what? Associates. So yeah, once again, this is also consolidation. And I think consolidation will probably be the last topic or last but one. Because it always comes. So we want to reserve it for like the last killer. And also with consolidation, you need to know almost everything, okay, before you tackle consolidation. So one entity is a joint venture of a third entity. It should be third party entity. And the other entity is an associate of the third entity. The entity is a post-employment benefit plan for the benefit of employees. This IAS 29. This is outside the scope of FR. This scope reporting. The entity is controlled or jointly controlled by a person identified as a related party to the reporting entity. A person identified as a related party of the reporting entity has significant influence over the entity or is a member of what key management personnel of the entity. This whole thing has in influence, significant influence, and all those things is just determined by the number of shares you have in the other organization. So if we have Opoko Limited and I buy like, let's say 80% of the shares, okay, I have significant influence. I take like key decision. Okay. So in that case, there is what a relationship that exists between the company and myself. Exclusions. Exclusions of related parties. So in the context of this standard, the following are not necessarily related parties. Two entities simply because they have a director or other member of key management personnel in common. So we have company A, so A Limited, B Limited. it's possible that I can be a director here and be a director here. Okay, so let's say Shadrach. By virtue of me being a director here and director here doesn't make these two entities related parties. Do we agree? Or you think that by virtue of they having a common director, automatically they are related parties? Oh, I didn't hear what you said.
No, no, not necessarily.
Okay, not necessarily. Yeah, it's some people. Should I say that's what they do? If you're able to build experience, capacity, and publicity up to a certain level, you get invitations to be serving on like the boards of company. So company ABC, board of director, maybe non-executive, another. I think my boss, my managing partner is like the board member of one hospital in Eastern Region, and he's a managing partner of at Financing Consult. So by virtue of they having a common, let's say, director, doesn't make Financing Consult and that particular hospital a related party. Okay, two ventures simply because they share joint control over a joint venture. Joint venture, FR, joint venture FR. No, joint venture. I think that will also be CR, and that is where you also do the console cash flow. Cash flow, there is console aspect of it, but that's also outside FR. Providers of finance. So if you go to the bank for finance, that mommy loan, or you go to your friend, Charlie, I need some funds to fund my business. Okay. By virtue of receiving funds from the bank or the friend, doesn't make your friend and the company related parties. And yes, Adianka, all the banks will be related parties. Okay, to the entities that we are serving as the accountant. Trade unions, public utilities, government departments and agencies, simply by virtue of their normal dealings with entity, a customer, supplier, these are not related parties. Even though in our normal course of business, we will be meeting them day to day, time to time, and all those things. It doesn't make them our related parties. It is more of control. Once again, it's more of the consolidation point of view, from the consolidation point of view, and also with key management. Key management. So key management personnel are those persons having authority and responsibility for what planning, directing, and controlling the activities of the entity, either directly or what indirectly, including any what director, whether executive or non-executive of that entity. So we are looking at the director and the entity. That is why if, please, this is just an example. If director buys company car for let's say 2,000, 3,000, obviously and a director, you get it. And I think in some, is it under the same standard? Yeah, the same standard. Such a transaction has to be disclosed separately. It has to be disclosed separately. Yeah, so transaction that transpires between directors and the organization is considered as what? Related party. But transaction that transpire between entities with a common director is not considered as what? Related parties. Please, do we get it? Um, so transaction between A Limited and Shadrach related, B and Shadrach related, but A and B is not. It's not. By virtue of they having a common director, it's not. Close family. Once again, take note of this. A minute. As I said, when it comes to examining you guys on IAS 24 as a standalone standard, what I have seen so far, or the portion that is mostly examined, has to do with the key management personnel and also with a close family member. Okay. Sorry, my things are popping up. Okay. Okay. Close family members. So close members of the family of a person are those family members who may be expected to influence or be influenced by that person in their what? Dealing with the entity. So they include children, spouse, children of that person's spouse or domestic partner, uh, dependent of that person or that person's spouse. I wanted to say something, but I think I have to keep quiet. Hello, can you hear me? The
Yes,
net.
yes, yes, we can.
Okay, okay. I thought my network. Okay, so we've talked about who a related party is. We are now coming to look at related party transaction. Okay, we've been talking about who a related party is, people that we are in a control relationship with, or close family member, or key management personnel. Now we are coming to look at the transaction itself. So, a related party transaction is a transfer of what resources, services, or obligation between a reporting entity and a related party, regardless of whether a price is charged. So it is just like any normal transaction. What makes this one special is that it transpired between a related party and our entity. So where there have been transaction between the entity and a related party, the entity is required to disclose one, the nature of the related party relationship. So I sold goods to my parents, I sold goods to my subsidiaries. Okay. The nature of the transaction. So yeah, that would be the transfer of goods. Defining the relationship has to be with the parent and subsidiary relationship. Okay, then we look at the amount, any outstanding balance. So 5,000. Let's say they paid 3,000, so we have an outstanding balance of what? 2,000. You are required to disclose this in your financial statements. Any provisions for doubtful debt remaining to the amount of any outstanding balance. Once again, if you sell goods to your man, I don't know for you guys, but for me, I think I already have like 10%, 20% bad debt already incurred because they will give me stories. They will give you stories like the birth of Jesus Christ. They will narrate everything point on point. So you'll be forced to give out discount and other things, right? So if such thing transpires between you and your parent company, okay, you have to do what? You have to disclose it. So example of related party transaction, purchase and sale of goods, purchase or sale of property. So once again, like your normal transaction, it is not any like extraordinary transaction. They are our normal transactions that we do on daily basis. The only thing is that it is between us and our related parties. So importance of related party disclosure. Investors invest in a business on the assumption that it aims towards maximize its own profit for the benefit of what its own shareholders. If you study FM, they will tell you that the financial objective of every company is to maximize what shareholders worth. So this means that all transactions have been negotiated at arm's length between willing and informed parties. The existence of related parties may encourage directors to make decisions for the benefit of another entity at the expense of their own shareholders. So if we give discounts, our shareholders will lose because at the end of the day, our profit will go down. And if our profit goes down, it's going to have effect on the dividend that we'll be paying. So our shareholders will be the ones to lose. When we give discount, it doesn't affect our salary. Okay, at the end of the day, we will still receive our salary with our bonuses. This can be done actively by selling goods and what services cheaply to what related party, sometimes strategically. So this is outside our standard. This is like strategy point of view. They intentionally set up a subsidiary in other places because of what? The cost. Example, an organization, let's say US, let's say manufacturing organization, okay, will intentionally go and set up their factory in China because China labor cost is very, very cheap, very, very cheap. Okay. Now, because it is also a subsidiary, they may sell it at an amount that probably the only thing they can do is to break even so that they don't even pay tax in China at all. Right. So that is strategy point of things. But let's look at accounting. Let's come back to accounting. So this can be done actively by selling goods and services cheaply to related parties, or by buying in goods and services at an above what market price. So this also happens where you want to shift tax. That is why GRA will be interested in the related party transaction. We think Ghana here, our tax rate is very harsh. Okay, so and we will be making a lot of profit here in Ghana. So we don't want our profit to be taxed here in Ghana, let's say at a rate of 25%. Our general tax rate is 25%. But let's say we have our head office in, let's say, US, South Africa, let's say South Africa, okay. And maybe we have some concession. We are not paying anything. So what we will do in order to shift our money from Ghana to South Africa so that we will not pay any tax on it will be for us to buy some of the products from our own people in South Africa. And when we are buying, instead of, let's say, they selling the things to us, let's say $1 each, they can sell it to us, let's say 3. So at the end of the day, we will end up paying more so that we can shift funds from Ghana to South Africa so that we will not pay any tax. That is from the group point of view. Okay. So that's what happens. So, or by buying in goods and services at an above what market price. So yeah, that's it. It can also happen when directors choose not to compete with a related party or offer guarantees or collateral for other parties' loan. Disclosure is particularly important when a business is being sold. It may receive a lot of customers, suppliers, services, or general help and advice from the family or the group of companies. When the company is sold, these benefits may be withdrawn. So it is important that whoever is coming to buy the company is informed that, oh, okay, there is an existence of related party. So we have to go back here. So there is an existence of related party. The relationship has to be defined. The nature of the transaction. Maybe they are running our marketing campaigns for us for free. If it's free, then it has to be. That's the amount. If it's not free, you state the amount. If you are actually on your related party. So you see, at the end of the day, it comes back to the site. Okay. So any question before we just look at some few questions, then we end the class for today. Any questions with related party disclosure. Any question? Oh, a number saying, hello.
I think this is straightforward, so that's fine.
Okay, Matthias, any question?
No questions, sir.
Okay, okay, sure. I think you can just, some people have dropped. Okay, let's just solve this question and I think we can end the class. Yeah, you decided to set up a business in an office block offering training facilities. Your brother is the owner of the building, and in order to help you start your business, he agrees to give you an office with no charge for a 4-year period. After 3 successful years of business, your student numbers have doubled and you decided to take early retirement and sell your business. Your business is being put up for sale. Required. Explain what information should be disclosed in the account regarding this transaction and why it is important to do so. Anyone willing to try? Anyone willing to try? Salasi, are you willing to try? Or Doris? Or Matthias?
I think there was something we studied about family,
Mhm.
siblings, and all of that. Uh, explain information. What information should be disclosed in account recognition and why it's important.
So, what information should be disclosed? What do you think should be disclosed in our financial statements? Oh, you people should
Okay,
try.
so the information around a relationship with the owner of the building. So rent has not been paid or rent will not be paid for 4 years. Okay. So the way my mind is processing this could be a successful business only because rent was not paid for the 3 years that the business was in operation.
Yeah, it's possible. Just that it doesn't answer the question. What information should be
Yeah, so what
disclosed?
information should be disclosed? I think
Uh-huh.
it's the relationship thing, no?
I think I thought I heard someone's voice. Okay. So at the end of the day, these are the information that needs to be disclosed. Just that it should be tailored to the question that has been given to you. So one, the nature of the related party relationship. So there is a related party, yes. What's the nature? That's his brother. Or the nature of the
Yes.
transaction, rent, the amount is free. Or is there any outstanding balance? So this
Uh,
is very key. So let's look at the solution. I think there should be a solution. Yeah.
but all that you said is my response. Just I didn't follow this format, obviously. I did that too.
So you must disclose the nature of the related party transaction. So the related party transaction. So rental of premises. The related party. His brother owns the place. Okay. The amount of what? The transaction. And he's saying that the fact that you have used the premises, the premise rent free, okay, and how much rent you are saving. So this is something that you need to disclose, that there is a related party, and that's the brother, and there is a related party transaction, that's the rent of the premises. And when it comes to the amount, your brother has given you the place to use the place for free. You get it. So this information is important for a prospective buyer of the business because they will need to be aware of this fact when they look at what the profit of the business or for the business. If you do not, it's not the dent, it should do not. If you do not disclose this matter, the prospective buyer will think they could make similar profit when they purchase the business. Although the profit figures are correct, they are what distorted on the fact that the new owners would incur what rent charges for that building, and hence the profit would reduce, assuming all things remains the same. Omega just economics omega just all things being equal, ceteris paribus. I'm an accountant. Okay, so that is the important. The reason why we have to disclose it. Definitely, before they buy the business, they will look at our profit margins. Okay, so they have to be aware that okay, whatever profit we are making, it excludes rent. And the moment they buy their business, they have to start paying rent. So if they are working with some figures or some computations, and those computations needs to be adjusted, most likely they would come for our previous year's financials. And this is what happens in practice. Okay, previous year's financials, and they'll assess our performance and use that to build some forecast. So if the previous year financials we give them doesn't include rent, most likely they may not include rent. They may think the building belongs to the business. Okay, so they would be thinking that, oh, the business has an asset worth this much. They would make payment, then at the end of the day, your brother will come and tell them that I give you guys 2 weeks to vacate or vermouth out of my building. Then it start creating a whole lot of problem. So it needs to be be disclosed. Okay, any question? If no questions, you will end here. Once again, this is a disclosure standard. It talks about things that needs to be disclosed, and that's all. No computations, more or less, unless the examiner gives you something that requires maybe discount or some adjustments, or okay, there may be some computations, but ordinarily there's a disclosure standard. Any question? Any question? If no question, we can end here. Any question? Any question? Any question? Okay, so I guess you guys don't have any question from me. So we'll end here, and thank you for your time and enjoy the rest of your evening. Bye.
Thank you so much. Catch you on Saturday.